Hello, everybody. Thank you so much for joining today's session. My name is Keeley Simpson, and I will be guiding you through our final series of our Savvy Women Investors presentations that we've been running for the past few weeks. Today's session is really focused on retirement planning and for women who are almost at retirement or already retired. So hopefully you can enjoy today's session. I would also like to thank the McGill Women's Alumni Association for partnering with me and giving me the opportunity to speak with all of you here today. It's a big passion of mine, and I hope that you find today's session informative. I'll just give you a bit of background about myself before we begin. My name is Keeley Simpson, and I'm an Associate Portfolio Manager and Wealth Advisor based in Toronto, Ontario. I'm from Montreal, and I went to McGill, obviously. And I work on a team, and we have about 200 families that we help with their wealth management needs, and most of our clients are in their 60s or older. So hopefully today I can try and share as much knowledge with you as possible on the questions I get most often from my clients or the issues that I deal with for my clients on a regular basis. And then just one other thing that I would like to share is I'm actually a mom of three kids, 3 and under. So it's really busy over here, and 2 dogs, two of my babies, my fur babies, as they say. So if you hear any barking or any screaming, I apologize. With working from home now, we here in Toronto, we've been in lockdown since November and a stay-at-home order for quite a while now. So I'm just here in my home office. So if you do hear anything, I apologize, but that's just the that's where we're at. So I'll begin now by sharing my screen, and we'll get going. So I'd like to start off with a quote. So money is genderless, but investing for women is different. And just to set the stage a little bit for today, is that women just generally tend to be less confident in their knowledge about finances than men. And this uncertainty extends to the retirement planning, financial planning, wealth planning, investment management aspects of your financial life. And we do know that knowledge leads to hands-on involvement, and those who consider themselves knowledgeable are at least 3 times more likely to report being very involved in monitoring and managing their retirement, which obviously results in a healthier retirement savings plan. And in terms of risk, it comes to probably to all of you is no surprise that generally men in these studies are more willing to take on risk than women. And that's because as women, we tend to have some underlying fears, and there's a term that a lot of my clients use, and it's becoming that bag lady. So that's why I like to start off with this quote. And then the other quote is that planning is bringing the future into the present so that you can do something about it now. And that's just a little bit about the power of planning when it comes to retirement and other goals you may have. So today's agenda is as follows, and I really would love to encourage you all to ask questions as we go on through this presentation. We are going to save the question answer period for the end of today's session. But please ask as many questions as you have, and I will try to get through all of them before the time is up. So don't be shy. Well, I mean, you can't actually be shy because I can't see you and no one else can see you, but please feel free to ask questions that you may have, and I would be happy to respond. So the quiz for today is going to start in a moment. So I would get out a pen and a paper, or maybe just a notes tab on your tablet or your computer just to take some notes. I'm going to talk about why investing for women is different. I'm going to also touch upon the unique challenges that women face when it comes to retirement planning. I'm going to talk about the 9 biggest retirement mistakes and how to avoid them. We're going to talk about the basic steps to building your net worth. And then we're also going to talk a little bit about what responsible investing is, only because I've received so many questions about this lately. And then I'm going to talk about selecting an advisor and what goes into that. So based on where you're at right now, when it comes to this quiz here, what are your goals and what are you doing to reach them? So do you know right now, in terms of your gross income, how much you're saving and how much of that is your net income? And then to maintain your current lifestyle when you do go to retire, how much money will you have needed to have saved? What are the 3 sources of retirement income for you going to be? How much income is each one going to provide you? We're going to talk about that today. And then what was the return on your investments or savings last year? And obviously last year is a bit of an anomaly, given that the markets went crashing down and then were lifted back up. But just maybe over the past couple of years, do you know what the return on your savings were or your investments? So women tend to learn before they invest. So based on some of these studies that have been done, it can be concluded that generally women like to be very informed and knowledgeable before they invest. So we communicate differently as women. Certainly women have different life experiences than men. So statistics do show that women on average invest in more conservative investments, and that may or may not be true for you. And then, you know, what else I'd like to talk about is the unique challenges that women face when it comes to planning for retirement. So it's typically presented as a couple's experience, and that may or may not be true because sometimes we have divorce later in life, some women become widowed, and some women are single, and they just, they never do marry. So the fact that it's presented as a couple experience is not realistic for some. Generally, women tend to have a smaller nest egg that they start with, and that's only because if you leave the workforce to have children, and even if that's a year off, that's 1 year where you're not contributing to your retirement plan or to the Canadian pension plan or the Quebec pension plan. So that's what I mean by a smaller nest egg. Women are living longer now, and also longer than men. That confidence piece when it comes to investing, so just a little bit less confident than their male counterparts. The non-financial aspects of retirement, though, women do come out ahead, and that tends to be because of the fact that men's identity, they tie their identity to their work, whereas women tend to be more relationship oriented. So that means that when you actually do go to retire, you are not depending on the identity that you've had through work. And then that other sort of aspect is that men and women are complementing each other. So this is the retirement expense worksheet that I have available, and if you'd like to receive it, just let McGill know, let us know, let me know, reach out. So basically what it is it's an Excel spreadsheet that allows you to put in your fixed and discretionary monthly expenses. So whether that's your mortgage, condo fees, rent, taxes, groceries, coffee, whatever it is that you're spending money on, you can put it in there as your current expenses, and then you can take the money, that the monthly amount that it is, and you can basically move it to a future amount. So that can show you basically what your expenses are now and what they're going to be in the future. So if you'd like to receive this, just let us know and we can send that out to you. It's very handy. The next is, what does retirement look like to you? Oopsies. So again, that women are living longer. Retirement is no longer a set point in time. It used to be that, you know, you turn 55 or 60 or even 65 and you get that watch and you're sort of out the door. We also have what's called the sandwich generation, which means that women are taking care of their parents at the same time as their children or even their adult children returning home. We also have this aspect of what's called the declining pension. And what I mean by a declining pension is that companies, they used to basically help their employees save. And they used to do that by creating what's called a defined benefit plan, where the liability was on them to make up the difference for their employees. And you would retire with your average 5 years of earnings, and you'd be well taken care of from that perspective. The problem with that is that companies lately have not have been shying away from that route, just because it's expensive for them, and then they want to make sure that employees are also responsible for their own savings, so that the onus is now put on to the employees to save. And then there's also this other phenomenon that's been happening, especially with housing prices being so expensive now, is that women are now retiring with debt. Well, actually, most people, men or women, are retiring with debt. So when you're putting together your expense worksheet, you want to make sure that you're going to have enough retirement income to cover whatever outstanding debt you have, or maybe you want to put together a plan that allows you to pay those debts off before you commit to that retirement. So just to summarize, women are now taking care of their parents. Women may leave the workforce for a longer period of time to care for their children. Adult children are returning home. Caring for grandchildren so that their parents can work is another something else that I see a lot with my clients. Outliving your spouse, so becoming a widow or divorce. I know it's been a lot in the news lately, but Bill and Melinda Gates are getting a divorce now, so it can really happen to anyone. And then working longer, how much and in what capacity. And so we're going to touch upon that. So these are some of the rules of thumb and retirement myths that I hear a lot about. And I'm fine to have that company pension plan. So again, companies are no longer, most companies are no longer offering that to their employees to have that defined benefit plan. I need 70 to 80% of my pre-retirement income, and that's really dependent on what your expenses are going to be like when you do actually retire and what your taxes are going to be like. I've heard I need to save $1 million. It depends on what your expenses are going to be. And then I will be fine if I only withdraw 4 or 5% a year from my savings to when I retire. This is a good rule of thumb. I like to use the 5% rule. So if you take out 5% if you take 5% of your total portfolio, so say it's $1 million. And say you have $50,000 a year in expenses, if you only spend $50,000 a year without any other retirement income sources, then you could live off of your investment portfolio for a long time. The only caveat with that is that I would say your return on those investments would need to be higher than inflation. And right now what we're seeing in the marketplace is inflation concerns, and that's because interest rates have been so low for so long now. And well, inflation is becoming front of mind to a lot of the people. So how to avoid the 9 biggest retirement planning mistakes? So I think you really want to consider building out what's called a worst case scenario financial plan or retirement plan. So you want to work with a professional who can, if you're getting very close to retirement, which I would assume based on today's presentation that it's really for people who are basically retired or just about to retire, that you really want to consider building a worst case scenario plan. A worst case scenario plan is really just what happens if the market goes down by 20%, or what happens if my spouse or partner passes away, or what happens, like you want to sort of have a worst case plan. Outliving your wealth is it's a concern for a lot of people. Now, when I'm doing plans, I plan for them to be living until 95 or 100. And that's because of the longevity that we're seeing with people with how long they're living for now. And then that failing to account for inflation. So inflation is really quite a concern right now. So I think you really want to take that into consideration if you're about to retire. Then another question I get a lot is how and when to maximize those pension plans, right? So you've got the CPP or the QPP if you live in Quebec, and then the old age security. So how and when to maximize those payment plans for you into your retirement income sources, minimizing and reducing taxes, both leading up to and during retirement. So you want to have a tax minimization strategy when it comes to your planning. I think this is really key. And I'm not saying not to pay taxes, I'm just saying that you want to try and minimize taxes through whatever planning you're doing. You want to try and minimize whatever taxes you are paying. And there are some strategies that you can implement for that. You want to also make sure that you have lower fees, and you want to minimize your costs so that you can keep more of your savings. So that's one other aspect. I think it's important that you want to work with an advisor who is a fiduciary. And what I mean by that is you want to work with someone who is a licensed portfolio manager, because they have a fiduciary duty to all of their clients, and it's a legal obligation. So it's just a higher standard. It's basically a license that is very difficult to obtain here in Canada, and it is something that you probably want to consider, just because there are many advisors out there. But if there's 100,000 advisors in Canada, only 1,500 or 1,000 of them, between 1,000 and 1,500, I don't know what the statistics are right now, but very low percentage of advisors are actually portfolio managers. So that's something that you want to consider. You don't want to miss out on the growth and the upside when it comes to the equity and fixed income markets. You want to try and improve those bottom line results. And I think that you want to consider being a bit tactical with your shifts when it comes to your portfolio, because you want to make sure that you're invested in the right sectors, and you want to make sure that you're invested in the right companies to help lift up your portfolio. And then the final piece is protecting and preserving your portfolio should we enter into a 2008 market environment. So what we saw last year was obviously very scary. We had a market crash and crisis at the same time as this health crisis, which had never been seen before. And I received a lot, we were speaking to our clients on a daily basis, obviously. And we talked a lot about that principal protection and preserving clients' portfolios when the markets basically went down by 35%. And so we had to implement some strategies before that happened. And we needed to make sure that we managed the risk on people's portfolios. And then when we saw that things were improving to a degree where we felt comfortable reinvesting in the market, we basically took some cash that clients had and we reinvested it when the markets were lower. Now, we could have been wrong on that. The market could have gone lower from where it was, but we felt that things had gotten to a point where they were oversold enough that we thought it made sense to buy some good quality names at that point. So protecting and preserving your portfolio, I think that's really key. So I do have some checklists available for you. If you are interested, please let us know, and we can send that out with the retirement expense worksheet. So it's a checklist that's 10 years to retirement. So if you're 10 years to retirement, here are some of the strategies that you want to implement, right? So you want to make saving easier with a strategy that works for you. So you want to set up a continuous savings plan. You want to consider an RRSP loan. If you're getting closer to retirement, you want to make sure that you can pay that off before you actually do retire. And you want to consider, investing early to generate and take advantage of compounded growth. And there are some other aspects on here that I think you want to consider. So we are so depending on what stage you're in, just let us know which PDF you'd like and we can send that out. So the next part of our presentation is it's going to be actually building out this plan for you. So I think you probably want to get out a pen and a paper if you hadn't already. And I think that you maybe want to start scribbling down some numbers because really the first step is to have a plan. So you want to create a balance sheet. So how much do you spend and how much is left over every month, every year? You want to create a statement of net worth. So basically a statement of net worth is what assets you own, and then whatever you deduct, whatever liabilities are owed against them. So if you own a home or a cottage or a rental property, you know, so what's that building worth? What's that house worth? And then whatever the outstanding mortgage is on it, that's your net amount. And then you also want to include in there whatever you've saved in your retirement plan, whatever pension plan you have. If it is a defined benefit plan, that's still considered an asset. Whatever tax-free savings account savings, like really any sort of savings that you've accumulated over the past few years, you want to include that as your assets. And then whatever outstanding liabilities you have aside from like a mortgage or anything like that, you want to include, and then basically determine what your net number is. And then the other important piece is you really want to pay yourself first. So how much can you save? But how much should you be saving to reach your goal? So these are some of the things to consider when you start building out your plan. So paying yourself first really means that you want to have a budget. And so that expense worksheet helps to lay out all your expenses for you and show you, you know, where could you be possibly saving some extra funds to help reach your retirement goal. You also want to have an emergency fund. Emergency funds are generally 4 months of net income saved into just a savings account. You don't really want to have that invested just because you want to have access to it at any point in case there's an emergency. And so if you have that money invested, then if there was a market crash, then that sum of money may not be the same. So you want to make sure that you have it accessible to you in case there was some kind of an emergency. You want to save inside of a retirement savings plan if you're currently earning T4 income and inside of a tax-free savings account. And I did see a question come by about TFSAs. So I am going to answer that at the end. And then you want to have a reinvestment program. So I can't stress this enough. When you have accounts like a RRSP or a tax-free savings account, if you have dividend-paying securities inside of those accounts, you want to make sure you have a dividend reinvestment plan on them, because you can continue accumulating more of the security without any actual purchases, like it's just done for you, and it will help with that compounding tax deferred growth that that you can obtain inside of the account. So it just helps maximize your tax-free returns. So the next is setting your objectives. So I'm going to spend some time on here. So if you want to take some notes, please feel free. I think this is a really important slide for this this age group. So wealth planning, what does that mean? We do this with our clients. A wealth plan is very important. So basically it's a retirement plan, but it encompasses estate planning, tax planning, any major purchases that you want to make, any trust planning, and then gift planning and legacy planning. So first of all, you must have a plan. If you don't have one, and you don't necessarily want to speak to an advisor right away, maybe something that you could do is go to your local bank branch and ask the local financial planner inside of that branch to create a retirement plan for you. It's free. It's all part of being a customer at the bank. So, you know, I think that would be a good starting point if you don't have one yet. Major purchase. So are you going to be downsizing your current home to buy something else when you retire, or are you going to be keeping your home and do you want a second property? So here in Ontario, there's been a lot of articles written about the state of our real estate market and just how high it's gotten. And then even more specifically, that the cottage market is really active right now. And so if getting a second property is part of your dream, how do you make that happen? Tax planning is really, obviously the CRA is going to get their pound of flesh, so to speak, but there are ways to minimize the amount of taxes that the CRA is, required to get from you. And then there are ways to make sure that throughout your life, you are minimizing the amount of taxes by either a tax deferral or, a tax, a tax minimization with certain strategies. So when you turn 71, the following year, you have to basically start drawing on what your RRSPs are. So whether you have an RRSP, so a retirement registered savings plan, or a locked-in retirement account, which is called a LIRA, those need to be converted into what's called a retirement income fund or a life income fund, which is locked in. So let's say, let's say you've been very fortunate and the markets have been really good to you and you've had a good saving strategy over the years and you have $1 million saved in your RRSP and LIRA combined. And let's say you're turning 72 next year. So this year would be the year that you need to convert it. So in the first year, it's about 6%. So let's say it's 60,000. So you would need to draw from that account $60,000 would be your minimum withdrawal, or if you have a younger spouse or partner that you're common law with, you could use their age to reduce the amount because it's based on your age. And what I mean by the tax bomb is if you were required to take out $60,000 from that plan, and then you add in your CPP or your QPP if you live in Quebec, and let's say that's $12,000 a year, and let's say you have some other income of $5,000 or $6,000 a year, if you're getting close to that $80,000 tax bracket for retirement income, then you're going to be in a higher tax bracket than you probably like. So you're going to be paying higher taxes. And so there are some strategies that you can implement to make sure that you don't have that tax bomb sort of put on you. The other thing is that the old age security starts getting clawed back by the time that you start earning, I think it's between 70 and 80,000 up to 140,000. Basically, if you had 140,000 a year, it's definitely clawed back. And then it starts getting clawed back by the time you start earning $70,000 a year. So, I mean, you've been paying your taxes. You've been, obviously the old age security is a social security payment. But I mean, if you want to try and receive some kind of compensation for that, then you want to make sure that you know exactly what your tax situation is going to be like when that quote unquote tax bomb comes around. Estate planning. So when was the last time your will and your powers of attorney were updated? Because this is really important. You don't want to pass away without having a will in place. And you want to make sure that your loved ones know exactly what you want. And you want to make sure that you have powers of attorney for both property and care, because if something were to happen, then you want to make sure that those people can care for you the way that you would have wanted. And then the other phenomenon I've been seeing a lot lately is the use of a corporate executor. So a corporate executor is really like a BMO trust, for example. So with BMO, we have what's called BMO Trust. If you're with CIBC, it would be CIBC Trust. If you're with RBC, it would be RBC Trust. You get the drift. So a corporate executor really can come in, and obviously they have a payment schedule, and it's based on a percentage of the assets that you have left in your estate. But they can execute everything for you. And actually, if you appoint an executor, whether it's a friend or a family member, they can get compensation of up to 5% of your total estate when they go to execute it for you. So there's not really a cost savings when you're appointing a family member or a friend, unless that person wouldn't charge it, quote unquote. So that's maybe something you want to consider, because they make it very clean, they do exactly what you wish, and it's just something that maybe you want to consider. Trust planning. So a lot of our clients, we do use trusts so either a family trust or a spousal trust, an alter ego trust. This really allows you to do some tax planning around what would be left over and make sure that the proper beneficiaries receive the amount of money that you want them to. So if you want more information on trust planning, just let me know and I can send you a more detailed PDF on it. Gift planning and legacy planning. So I want to spend some time on this because actually in the past year, and I'm not sure if it's because of the pandemic, but a lot of clients have asked us to update their estate plan. And in doing that, we've actually set up quite a few what's called a donor advised fund. And that's when you basically, if you had leftover funds inside of your estate that you wanted to donate, you know, you can set up what's called a donor advised fund. But you can actually take advantage of that today and set it up while you're still alive if you want. The minimum amount that you would have to transfer into a donor advised fund is $100,000 to start one. But then after that, it just stays as $100,000, and then you would have it invested the way your other accounts are invested, but then you can actually donate the appreciation every year as well as the income, or even a bit more. And you can basically have these grants that go out to the organizations that you're really passionate about or want to help, and basically make sure that they're, you know, that they're getting it every single year. You can donate appreciated securities into a donor advised fund so that you can take advantage of the taxes on that, so that you are not actually selling the securities, but you're donating the appreciated securities, so you're getting a big tax credit for that. And if you do it while you're still alive, then that can help against that age 71 tax bomb. And then setting up a legacy. So one example is the McGill Women's Alumni Association. They have a scholarship fund. And actually, in honor of McGill's bicentennial, the university has actually launched the 200 for 200 Legacy Challenge. So what that means is that they're aiming to raise 200 legacy gifts for their 200th anniversary. So if that's something that you're interested in, you could actually appoint McGill or the scholarship fund, for example, with donated appreciated securities, and then you could actually create a legacy. So as with a legacy gift, it can be designated to support a specific area or cause. And for example, you can decide to support the McGill Women's Alumni Association Scholarship Fund, which I just mentioned, or you could also support the area at McGill that is most meaningful to you. And I'm not sure what that area would be, but maybe it's the program that you're in. And it can be named after yourself or even after a loved one. So to learn more about legacy giving at McGill and the 200 for 200 challenge at McGill, you can go to mcgill.ca/legacy, or you can contact Kay or someone who at the Bequests and Planned Giving office to get more information. And so I think that this is something that we're going to see more often in the next few years, because it's becoming just really front and center for a lot of my clients. And I think that if this is something that you're considering or interested in, I think that you should try and get some more information on that to see how it would work for you. Obviously, you don't want to donate money if you feel like you're going to need all of that money while you're still alive. You can also just do it as a charitable donation in your will. So the next piece is developing a retirement plan. So I see that we're getting quite a few questions. So I'm going to spend the next 5 to 10 minutes on this, and then we're going to go right into questions. So I'm going to probably go through this a little bit faster just to make sure that we cover everything, and then I'm going to get to those questions for you. So there are 3 sources of retirement income. There are government plans, which is the QPP, CPP, old age security. There's company pension plans, and then there's your personal savings. So your RRSP and your tax-free savings account. This is a graph about replacing today's income using a 5% inflation rate. So if your income today was $60,000, 10 years later, it would be like $98,000. So when you have to replace today's income, what I mean by that is an apple today is not an apple tomorrow. So you want to make sure that your investments are keeping up pace with inflation. The advantages of an RRSP are that they have tax deductible contributions and you can get that tax deferred compounding. When you turn your RRSP into a RIF, you still get that tax deferred compounding. You don't lose that. So some of the rules to live by if you still are planning for retirement is open a registered savings account, contribute your maximum if it makes sense, contribute early each year and or monthly, and invest wisely, so the 2% difference. So the 2% difference is, this is based on a $5,000 contribution into your RRSP every year, and so by the time you get to year 5, with a 6% rate of return, you would have $29,877 saved up into that plan. If you had a 10% rate of return, it would be $33,575. But let's fast forward a little bit to, I don't know, year 30. So year 30, you've put in $5,000 every year, you've had a 6% rate of return, you've been able to take advantage of that tax deferred compounding. You would have $419,008 saved up into your plan. Now, if you had a 10% rate of return for all those years, you would have $904,715, which is a lot more than 419. So, and obviously year 35, 1.4 versus 590, but you get the point. So I think you want to make sure that your investments are structured in a manner that you are, getting the best possible return for your risk profile. And we're going to talk about that next. So before we get into that, the tax-free savings account was introduced in 2008 by the federal government. I get questions about this all the time, so I just thought I would touch upon it. So you're allowed to contribute a maximum of $6,000 a year right now. The government did keep the limit in 2021 at $6,000. The investments inside of a tax-free savings account grow tax-free. So your interest in dividends, gains, all of that are tax-free. And if you've never opened one, you can contribute $75,500 today if you turned 18 before 2009. Some of the rules are you don't want to over contribute, and don't contribute, withdraw, and contribute again in the same year unless you know exactly the amounts that you have in terms of your limits, because there can be penalties for that. So the TFSA versus RRSP. So this is a comparison. I get questions about, should I do a contribution into a TFSA or an RRSP? And the fact of the matter is that you want to have a balance to your plan. And if you have a 40% marginal tax rate when you are contributing to your RRSP, and it's 40% when it's withdrawn, it's a net the same. So you have a net withdrawal of 8756 and 8756 from your TFSA. So it's net the same. Obviously, if you have a higher tax rate when you're contributing and a lower one when you're withdrawing, it makes more sense you're going to build up more inside of the RRSP because you're going to be taxed less when you withdraw it. So that's why I think you want to have a balance to your plan. And I'm happy to send out this PDF as well if you want more information on the TFSA versus RRSP. So when it comes to some legacy decisions, so if you were thinking about retiring today and you had $250,000 saved, if you're retiring today and your rate of return was 6% per year, and you were going to withdraw $18,000 a year for living expenses, then your portfolio would last 18 years. But if you waited that 2 years, if you could wait 2 years, then your portfolio would last 5 years longer, so 23 years. So you want to create and manage your investment portfolio or investment plan. So a lot of things that I know that we're covering a lot here, but what you really want to look at is your current financial picture. So what is your risk tolerance? If your portfolio were to swing by 10%, would that keep you up at night? If the market crashed, would you be calling your advisor to buy more, or would you be very nervous about that and ask to look at your options? That's what risk tolerance is. What's your time horizon? So if you're about to retire can you afford to have, 100% of your money invested in equities? Or do you think that maybe it makes sense to have more invested in fixed income? How much knowledge have you accumulated over the years, and what would your time commitment be to, working away at that knowledge piece? And then what are your goals? And we talked a little bit before about goals, so retirement planning, major purchase, gift planning, estate planning, those are all goals. So the investment menu is short term, which is less than a year. Then you have fixed income, which is bonds and preferred shares, and you have common stocks. So short term and GICs, for example, they offer very low interest rates because interest rates are so low right now. So like for a 5-year GIC, I can't even buy for clients, like even getting 1% is very hard. So I don't know if that makes the most sense unless you really want to have it guaranteed. But that's part of the challenge right now. I'm going to skip over this just because most people have money invested in a TFSA and a registered plan, so the after-tax rate of return is not that important. But if you have a question on the after-tax rate of return, just let me know. Government bonds and corporate bonds, so straight bonds, strip bonds, like these are all the different kinds of bonds. When you're buying a bond, you really want to know what's their credit rating, what's the likelihood that they're going to pay that annual coupon or semi-annual coupon rate, and what's going to happen if interest rates go up. Preferred shares pay regular dividends. They also come with a credit rating. And historically, prices were less volatile, but that's not really true because a couple of years ago, we really saw them fall apart. Now they've put new structures in place for them so that that doesn't happen again. When interest rates started going up a few years ago, we really saw them go down by 25%. So that really took a hit for clients who had a lot of preferred shares. So it doesn't necessarily mean that they're super conservative, but just generally prices were less volatile over the years. But they do pay regular dividends. So if you wanted to have a fixed income allocation inside of a non-registered account, so a non-taxable or a taxable account, then maybe this is something you want to consider because you can get the dividend tax credit. So common stock, you get ownership and they pay dividends for the most part, and then you get that capital appreciation potential. And then what the asset mix is of your portfolio will determine basically, how much your portfolio will be swing. So it's a strategic mix of stock, bonds, and cash. And why it's important is that it has a strong influence on the risk-reward trade-off. This is really the risk management, right? So it's the most effective method of accommodating everyone's unique investment preference. So last year, this is a chart of the stock markets, US and Canada, over the past 5 years. And you can see that last year, when the markets went down by 35%, that was a huge dip, but the markets have since come back quite a bit, and they're reaching all-time highs again. So it's important to be well diversified in your portfolio because it does reduce risk. It doesn't mean that there are not going to be market crashes in the future. It just means that the more diversified you are, the less risky your portfolio is. So diversification is by asset type, so fixed income or stocks, and then by industry. So like the past year, basically in this pandemic, last year we saw a lot of stay-at-home stocks, basically is how they were coined or dubbed, do really well. So like Amazon, for example, did really, really well. Microsoft, like all of these e-commerce type companies have done really, really well managing through the pandemic. And if they were able to pivot their business model, then they were doing really well. So this year, however, because inflation has been putting pressure on these higher growth names, there's been a shift in the markets, as well as the vaccine rollout in Canada. Finally, we're getting somewhere, but in the US, they're actually reopening. So we've seen this, what's called, quote unquote, the reopening trade. So that's been really interesting. So this year, you want to be more invested in cyclicals and financials, and you want to have more of the companies that are going to benefit from this reopening of the economy. And then, then the stocks last year that were working really well, like the stay-at-home stocks. And then by country, so diversification by country is Canada, US, international. The current market conditions, I've mentioned a few times that inflation has been putting some pressure on the markets as of late, and that you want to be invested more in cyclicals than what was working last year. And then what is responsible investing? So we can send this out if you're interested in talking more about that, or if I get a question on it, I'm happy to touch more on this. But basically, a responsible investment is an investment that aligns with values. It's a company that has risk management in place. They have active ownership, and they have sustainable opportunities. So basically, you're screening potential investments against a range of defined criteria, and you're entering into a dialogue with companies to discuss that, responsible, sustainable investment issues, and move towards best practice and active exercise of voting rights. So this is basically responsible investing really is alignment with values, and that's what you want to think about when it comes to responsible investing. We also have a global sustainable investing guided portfolio that we offer clients, just because that's something that's been very important to clients as of late. So some of the names in the portfolio are, and this is not like, you don't have to rush to write all these down. It's just some examples. So Xylem is one of them, Siemens, Sony, Lind, Ecolab, Bristol Myers Squibb, Novartis, Walt Disney, Coca-Cola. So these are just some of the companies that are in our sustainable investing guided portfolio that we offer clients. And they've all been screened against what's called the MSCI World SRI Index. So it's all been screened to make sure that they have responsible business practices and sustainable business practices in their when it comes to their management of the company. So when is the right time to invest? So the risks of market timing obviously is missing any upswings, and then potential taxable capital gains. You want to buy value, obviously, so that you can make some profit, and you want to buy dividend paying companies so that if the market did go down, you get paid while you wait. And then also going back to that dividend reinvestment plan, really make sure that you have a dividend reinvestment plan on your accounts if you are invested in stocks. Selecting an advisor. So the process is, so look, when you're thinking about selecting an advisor, you obviously want to have some interviews with a few different people, and you want to ask friends and family for some recommendations. You want to have an initial conversation with that person. Then you want to get a proposal from that person or a second opinion on how your current portfolio is doing, and get a sense and an idea of what that person could do for you. Ask about credentials, ask about their licensing, and then you also want to know what the costs are going to be. So fees versus commissions, very important. I see a question that I'll just touch upon right now, which is how are investment advisors typically compensated? What is the normal percentage range? So typically they are compensated based on the percentage of the overall portfolio, which is the fees, the management fees. And typically, it really depends on the size of the portfolio and also what the asset mix is. So if you have more invested in fixed income and cash, typically your investment management fee would be lower than if you had more invested in equities. But just generally speaking, if on the first $500,000, you would probably be charged, 1.5%, and then on the next 500, 1.25, and then on the next million, probably 1%, and then after that it goes down 0.75% and then lower and lower. This was that's really if you have mostly equities to invest in. If you had a more conservative portfolio, obviously the management fees would be slightly different, just because with fixed income, you're just, it's just not the same as equities, as managing equities. The services provided by your advisor are financial planning, setting goals and objectives, making sure that you have a wealth plan. They can provide you with investment research and advice. That's the primary responsibility. Asset management. You want to get progress reports, obviously. You want to make sure that you're getting your monthly statements or have access to them with your e-statements online. Financial updates and portfolio reviews, and then service expectations. So how many times a year are you going to speak to that person? Is it going to be 4 times? Is it going to be twice? Is it going to be annually? What can you expect in terms of service? And that's really a key question to ask in the interview process. So thank you very much for joining today. Again, my name is Keeley Simpson, and here's my email and my phone number. I am going to stop sharing my screen, however, because I want to get to these questions for you. So let's start from the beginning. How do I invest through a tax-free savings account? I want to invest in index funds, but where do I go to invest in that via TFSA? So if you wanted to do it yourself online and you specifically wanted index funds, then you probably want to maybe look like at a Wealthsimple option, which is robo-advising. And that way you could just open the tax-free savings account. You could move money from your checking or savings account, contribute it into that TFSA, and then you could have the model that Wealthsimple builds out. BMO also has one. It's called the BMO Smartfolio. And if you're interested in that, then we can send out information on that as well. But there's some robo-advisory options out there that specifically help you invest inside of index funds, inside of a tax-free savings account or RRSP or any account. Okay. How do you find an advisor who is a fiduciary? It's a good question. So you want to look for the term portfolio manager when you're looking for recommendations from friends or family members. I'm not sure if there's like a database specifically, but I can look into that. On the CSI, so the Canadian Securities Institute, if an advisor has become a fiduciary and they have what's called their CIM, so they're a chartered investment manager charter, then they would be part of a database on their website. So maybe that's another way to look for it. And then we already touched upon this. So how are investment advisors typically compensated? What is a normal percentage range? Hopefully that answered your question. What would be the best way to check eligible dividend, especially for an ETF? Online, you would just look at that ETF online and you would see what the eligible dividend is. And then you can see if it's eligible for the dividend reinvestment program, and it would be named DRIP on the website. So DRIP, D-R-I-P. Okay. Once retired, in what order should I withdraw money? So RSP, TFSA, investment account. Well, this really depends on your tax situation. So if you don't currently have, T4 income from the company that you're working with, and your RSP has built up to a level where when you do have to start drawing on it, you're going to have a bit of that tax bomb situation. What about taking some money out of the RSP every year just to draw it down a little bit before you are, you have no choice, and then also having that balance between the TFSA and then the investment account. And with the investment account, I think you want to look at setting up what's called an automatic savings plan to your account. And basically you could take the dividends that you receive in the account. So let's say it's $500 a month. And then those dividends could be automatically paid into your checking or savings account where you would need access to the money. But this is where you want to have a plan in place to see what order to withdraw from your investment accounts. And that's why a plan would be really important to help show you exactly the best way to minimize taxes and to have those funds last for the next 30 or 35 years. Okay. Is the 80,000 gross or net income for higher tax bracket consideration? It's gross. Okay. Perfect. Okay, we have another. My condo will not be paid off when I retire in 9 years. Won't be close to being paid off. Should I go back to renting now and start saving retirement? Well, not necessarily, because you'll still have an asset when you retire, and you're still, whether you're putting money monthly into paying a mortgage or rent, you still have that monthly expense. So you would only really want to do that if you needed the access to the capital to live off of when you actually do go to retire. So maybe it's something that you want to consider as part of your planning for 9 years from now. Like, in other words, keep living in your condo, keep paying down your mortgage like you would if you were renting, and keep having that accumulate in value, hopefully. And then maybe when you actually do go to retire, if you need access to, you know, to that money, to that net amount between the value versus the mortgage, then you could have that invested and hopefully pay you a monthly amount. And then that could go towards your rent every month. Hopefully that answers the question. Sorry if it's a bit complicated. What tax strategies can you implement to minimize taxes come 71 years? So some of the tax strategies are, if you have a big buildup in your RSP, not your LIRA, because your LIRA is locked in. So if you have a big balance inside of your RSP, what you could do is start drawing on that before you actually have to draw on it by the time you're 72, and withdraw, like, you know, 10, 15, 20, 25,000 a year, just to get that account balance a little bit lower, so that when you actually do have to draw the 6% in the first year, for example, or 6.5%, then then you could have a lower balance. That would mean that you would have a lower amount that you have to withdraw, and hopefully then you'll have a lower taxable income when you do turn 72. And that's just one idea. Another tax minimization strategy is deferral of capital gains instead of a non-registered account, making sure that your non-registered account has more companies that are paying dividends than interest-bearing securities. You want to hold your interest-bearing securities inside of your RRSP or your tax-free savings account, or any of your registered accounts that are tax-free or that grow tax-free. And you want to have the securities that have better tax credits available to you inside of your non-registered account. So these are just some of the examples. Happy to chat further about it if you have more questions about it. Okay. Is a non-RSP capital gain taxed less than in a capital gain in an RSP account when withdrawn, and say you are at the 70K plus income range? So actually is a non-RSP capital gain taxed less than capital in an RSP account? So I'm not sure if I understand the question clearly, but basically capital gains are taxed at 50%. So 50% of $10,000 would be $5,000, and then you would be taxed on $5,000. So your actual tax bill may only be like $2,500. But if you were to withdraw $10,000 from your RSP and you didn't have any other income, all capital gains inside of an RSP are not taxed. It's not a taxable account. So $10,000 withdrawal from your RSP, just if you didn't have any other taxes, would be a 10% withholding rate. So it would be $1,000. So it probably make more sense to withdraw $10,000 from your RSP than paying the taxable capital gains in your non-registered account if you didn't have income. But since you do have income in the $70,000 range, it probably makes more sense to to take a capital gain inside of your non-registered account and let your RRSP keep growing tax-free until you don't have any other income. Okay, I have been managing my investments online for the past 10 years. I'm quite satisfied with results, but I would really like to have consultation on my portfolio. Is this a service provided by a fiduciary? And if so, how would you suggest I locate a source? Thank you. Yes, of course. Anyone can provide you with a second opinion on your portfolio. If you would like to schedule a time for us to chat, I'd be more than happy to help you and take a look at it. I am a fiduciary, I'm a portfolio manager, so if that's something that you would like, then please reach out to me directly and I can help you with that. Okay. I'm not sure, I think that one's from McGill. Okay, I think, okay. Is a chartered, you guys are loving the questions. Like it, I love this, okay. Is a chartered investment manager the same as a portfolio manager then with a fiduciary responsibility? So a chartered investment manager, I have that designation, CIM, Chartered Investment Manager, and it just allows me to get the license of being a portfolio manager. The same of someone who has the CFA, a Chartered Financial, the CFA is another charter that allows you to have access to getting the portfolio manager designation. But your firm, whatever firm you're working with, they have their own protocols in place. Like just because you get the CIM, for example, does not necessarily mean that you automatically become a portfolio manager, because like with our firm, we have to be, you have to be licensed as an investment advisor for over 10 years. You have to have a minimum of $50 million under management, and you have to go through all of these supervisory interviews in order to be approved to have the license. So a person with a CIM would most likely have their portfolio manager license. They may or may not, but they would most likely have it. And they would have fiduciary responsibility as a CIM because of the licensing that comes with the CIM. Hopefully that answers the question, sorry. For someone who has real estate, do you think a reverse mortgage is a good idea? I do think it's a good idea. I think it depends on the specific situation. If you could send me maybe a more detailed question on that, it's hard for me to answer it just like that. I mean, do I think a reverse mortgage is a good idea? Yes, I do, but I would want to make sure that I'm answering it in the right way. So maybe if you'd like to have a follow-up question on that, I would be happy to answer that for you. I'm just not sure. I think it's a good idea. I just don't know what else you would want to know about it. Okay, so I think those were all the questions, and we went a little bit over, but not really, so that's great. So thank you all for attending today's webinar. If you have any questions, please feel free to reach out to me directly. McGill doesn't share your information with me, so any of these follow-up questions that we've seen, if you want to speak to me directly, please feel free to email me or call me or connect with me on LinkedIn, or feel free to fill out the Survey Monkey that we've put in the announcement here, and I can get in touch with you that way. Otherwise, thank you again, everyone, for attending. This is really such a pleasure for me, and stay safe out there. Have a great day. Bye.